Folks, I believe this is the single most important buying opportunity in the gold market in years. And I want to start with a fight, because right now there are two camps of investors. Camp 1 says gold is crashing and the bull market is over. Camp 2 says this is the single best buying opportunity since gold was at $2,600. And the difference between these two camps is not opinion, it is understanding. And by the end of this video you are going to know exactly which camp is right. And more importantly, you are going to know exactly what to do about it. Gold just had its worst week since 1983, down 11% in a single week, down 14% since the Iran war began. The metal that was at $5,418 just 3 weeks ago is now trading around $4,600, $800 wiped off in 3 weeks, and almost every retail investor is panicking right now. But here is what I think the market is completely missing. JP Morgan still has a $6,300 year-end target on gold. Deutsche Bank still has a $6,000 target. Goldman Sachs still has a $6,000 target. Not one of those banks has moved their targets despite this week's crash. Every single one of them sees this as a temporary correction inside a structural bull market. And I am going to show you exactly why they are right. But first, stay until minute 7. Because what I am going to reveal at minute 7 about who is quietly buying gold right now while everyone else is selling is going to completely change how you think about this moment. Now I am going to present my case, and then I want you to go do your own due diligence and be your own judge. Make sure you subscribe right now and hit that bell icon. Every single day I bring you the freshest stock analysis here on Stock Alerts Daily. Do not miss a single one. Now let me tell you what is actually happening with gold right now. Because most people think gold falls when there is war. But that is not what happened here. Gold surged from $2,600 to over $5,400 in 12 months. That is a 66% gain in a single year, the biggest 12-month rally in gold history. That kind of move does not happen without a reason. The reason was simple. Central banks were buying, the US dollar was weakening, US fiscal deficits were growing, and geopolitical uncertainty was rising. All 4 of those structural forces are still in place today. So why is gold falling? 3 reasons. And understanding these 3 reasons is the difference between panicking and positioning. Reason 1. The Federal Reserve just held rates steady and signaled higher for longer. When rates stay high, gold becomes less attractive because bonds are paying real yields. Money rotates from gold to yield-bearing assets. That is basic monetary mechanics. It is not a structural change in the gold market. It is a rate story. Reason 2. The Iran war is driving oil higher and inflation fears higher. Now here is the counterintuitive part that most investors completely miss. When inflation fears rise, the Fed has to stay tight. When the Fed stays tight, yields go up. When yields go up, gold goes down in the short term. Even though the long-term case for gold gets dramatically stronger because the underlying inflation threat is growing. In other words, the very same war that created the biggest tailwind for gold also created a short-term headwind through its impact on Fed policy. That is not a contradiction. That is how markets work. Reason 3. Paper traders flushing positions. Gold spiked from $5,296 to $5,423 on the Hormuz news, and then reversed hard as leveraged traders took profits. Physical gold demand stayed elevated. Physical premiums stayed elevated. It was paper money leaving, not real gold changing hands. That is what happened. Not a structural change, a technical flush. Now let me show you why the structural bull market is completely intact. And this is where the bear camp is making a very serious mistake. The bears are looking at the price and concluding the story is over. The bulls are looking at what is actually happening beneath the price. And what is happening beneath the price is extraordinary. Central banks bought 230 tons of gold in Q4 2025 alone. Even as prices were at record highs. Let me say that again. Central banks were buying gold at record highs. Central banks do not buy at record highs unless they believe prices are going higher. These are not retail investors chasing momentum. These are the most sophisticated institutional buyers on earth, making multi-year strategic decisions. They were buying at $5,000. They are still buying at $4,600. Global physically backed gold ETFs recorded $18.7 billion of inflows in January 2026, a record monthly inflow. That is serious institutional money building positions. The US fiscal deficit is not shrinking. The Iran war is making it worse. Every dollar of deficit spending is structurally bullish for gold over the long term. and de-dollarization trends that have been building for years have not reversed. The BRICS nations are still accumulating gold as an alternative reserve asset. None of those structural forces have changed. What changed was the Fed signaled higher rates for longer, and paper traders took profits. That is a tactical flush inside a structural bull market. Now let me talk about the price levels that matter, because understanding support levels is the difference between seeing opportunity and seeing risk. The all-time high was $5,418 set this month. Gold is currently around $4,600. First major support is $4,550. These were the late 2025 historical highs before the January surge. This level was resistance for months. It should now act as support. Second support is $4,300, the 50-day moving average area. If gold holds above $4,500, this is a correction inside a bull market. Full stop. JP Morgan's base case is $5,000 by Q4 2026, even after this correction. Ed Yardeni still targets $6,000 year-end. Now what does this mean for gold stocks? And here is where the real opportunity sits. When gold corrects, gold mining stocks correct harder because of leverage to the gold price. But when gold recovers, gold mining stocks recover harder too. Right now there are real gold miners trading at valuations that simply do not reflect what gold should be worth at $4,600 per ounce. One company I have been watching closely operates one of the highest grade gold deposits in East Africa. They just doubled quarterly revenue. Production guidance for 2026 is 25,000 to 30,000 ounces.